And say any of that. Good morning, everyone. How are you? My name is Nick DiTulio with Colorado Nonprofit Association. Welcome to Economic Relief for Hard-Hit Businesses and Nonprofits Act. Financial relief for nonprofits is finally here. It is presented today by Andrew and Kelsey with CliftonLarsonAllen. Before I pass it over to them for them to introduce themselves, I'd like to mention a couple things. As you see, we're in meeting format. We're going to have you keep initially muted just for that background noise sound that comes up every so often. So feel free to come off of mute or raise your hand if you have any questions a little bit. I think we are going to utilize the chat for questions though. So feel free to type any of those questions into the chat area. Kelsey and I will be keeping an eye on that. I see a post-evaluation email will be coming your way. That'll be my email as well, along with all the other emails you receive. So feel free to just respond back to that with any questions at all. And we will also be following up with the recording of this too. And that'll be by email after this session. So feel free to reach out with any questions you have. Without further ado, I will go ahead and pass it over to Andrew or Kelsey, whoever wants to take it away first.
Thanks, Nick. Kelsey, do you want to introduce yourself real quick and then I can jump off and get started?
Sure, sounds good. Thanks, Andrew. Hi, everybody. My name is Kelsey Vatsaas. I'm a principal at CLA. I've been with our firm for about a decade, and I spend all of my time working with nonprofits around the country. So excited to be here with a like-minded group of people. And like many of you, back about almost a year ago, found myself really trying to understand what was happening with all of these acts coming out and where were there opportunities to help our nonprofit organizations get access to resources. So I wound up on our firm's COVID response team representing our nonprofit group and have been helping nonprofits across the country as they navigate PPP-1, PPP-1 forgiveness, and now with the new Consolidated Appropriations Act, looking at can we apply for PPP-2? What about these employee retention credits? And how do we look at all of them, figure out what we're eligible for, and then actually go get them? So excited to be here today. A big part of our session today is going to be a case study where we kind of walk through. It's actually from a nonprofit that I work with, and I just kind of made it anonymous, but how to actually do that analysis, and hopefully gives you some good tools that you can take back to your organizations and try at home. So with that, I'll hand it over to Andrew.
Great, thanks, Kelsey. Good morning, everyone. Thanks for joining us. My name is Andrew Sexton. I'm a controller in CliftonLarsonAllen's BizOps group, so it's our outsourced accounting group. I work out of our Denver office here. Much like Kelsey, about a year ago, I was asked to do a little research into this thing called the CARES Act and the PPP program, and quite a bit has happened since then. So I've been operating as a kind of Colorado subject matter expert on the PPP program, not specifically focused on not-for-profits, but basically all entities that have been eligible under the program. So we're excited to talk to you today about some of the new changes and the new legislation that's happened over the last few weeks. So kind of going forward here, we're gonna start with our standard disclaimers. I'll kind of let you all read through those on your own, but you know, whether we're talking about the CARES Act or the Consolidated Appropriations Act that we'll talk about today, there's just a lot of unknowns, and we're just very careful about providing what would be termed legal advice. You know, and if you have questions, really, we're finding the best place to go is probably a combination of your accountants, your legal counsel, or even your lenders as it relates to the PPP program. Also, we just need to know that the rules around these programs have changed so quickly. So keep in mind that kind of what we know today might not be what we know next week. So today we're going to go through the the new Consolidated Appropriations Act that includes updates to the PPP program, including new rules for first-time borrowers, some opportunities for second-time borrowers, which includes some expanded eligibility for some entities. We'll also talk about the ERC, or the Employee Retention Credit, and some good news here as it relates to entities that have already participated in the PPP program. Some new provisions of the Consolidated Appropriations Act, or the CAA, is a Shuttered Venue Operator Grant program. So we'll discuss who's eligible for that program and how to calculate those grant amounts. And then, as Kelsey mentioned, we'll actually go through a case study that hopefully will be helpful. So kind of to start with, talk about some highlights of the CAA. It was signed into law on the Sunday after Christmas. the Paycheck Protection Program was among the biggest highlights of the program, and it provided an additional $284 billion in funding for both first-time borrowers that did not receive funds the first go-around after the CARES Act. And then it also created a second round of PPP for select borrowers that meet some certain criteria. So we'll go through those criteria in more detail as well. There's a timeline for borrowing under the new PPP program for both first-time borrowers and the second-time borrowers. The program runs from January 1st through March 31st. I will tell you that the rules specifically say that March 31st is the last day to apply for and receive a PPP loan. There's a little bit of confusion around whether this means last day to apply or last day to receive the funds. Do we have to have gone through the application process and be funded by this date? So I would really say if you're interested, make sure to reach out to your bank as soon as possible. Let them know that you're interested and see what needs to be done to make sure you follow those rules and get your funding and everything done prior to March 31st. And then we also know that once those $284 billion in funds are gone, they're gone. So if those run out before that March 31st date, then you would not be able to receive those. So act as soon as possible if you're interested in this program and believe that you're eligible. So kind of going on here, like we said, there's some new kind of borrower-friendly things that were included in the program. You see here, so it increased the eligibility for some different organizations, including 501c6 organizations. It included some additional eligible expenses that we can use PPP funds on. And then the forgiveness period, there's some slight changes there to exactly what periods we can utilize for forgiveness as well. So another major highlight of the CAA was the ERC. The good news here is that entities that previously were not eligible to receive the credits under the ERC because they also participated in the PPP program, that has now changed. You can now participate in both. Kelsey will go through in more detail the ERC, who's eligible and how to claim. But we mentioned here that there's no double dipping, which just means that any wages paid and credits claimed through the ERC can't also be included as expenses eligible for PPP forgiveness. But the good news that we're finding with some of the extended PPP time periods and the allowable costs, this shouldn't inhibit borrowers from still being able to achieve full forgiveness on their PPP loan and utilizing the ERC. So as with everything with these programs, there's a lot of guidance comes out, and the SBA and the Treasury Department did issue new IFRs or interim final rules as it relates to the PPP program and the second draws. We've referenced a couple of those IFRs. They're 80-page and 40-page documents, so there's quite a bit in there, but they're very useful if you have some questions around if you're eligible, how to use funds, and those sort of things. So those are good references. So let's kind of dive into the PPP part. We kind of say PPP1 and PPP2 and refer to PPP1. This is where new borrowers that did not participate in the program the first go around are eligible. And PPP2 is for organizations that received funding under the CARES Act PPP program and now have some availability to get a second round of borrowing if you meet these specific criteria. So the PPP1 in general is for organizations with 500 employees or less, and has now been expanded to include some additional entities that were not previously allowed. So those include housing co-ops, 501c6s, associations, and destination marketing entities. For these new types of entities, the co-ops, the 501c6s, and the marketing entities, you do have to be at 300 employees or less. So for the PPP2, really the two biggest criteria or things that we need to look at to determine eligibility are the size standard. So unlike PPP1, it's for 300 entities with 300 employees or less. And the big change is you have to be able to show a 25% reduction in gross receipts from any one quarter in 2020 as compared to that same quarter in 2019. So The forgiveness piece around the PPP program now is very similar to the first round, in that forgiveness can be achieved by using 60% of the funds on payroll. Then the remainder of those funds can be used to pay rent, utilities, and interest. And they did expand those eligible expenses now to include what they call covered operations expenditures, covered property damage costs, covered supplier costs, and covered worker protection expenditures. So for more details on what's included with these costs and the definition, the SBA did put out new forgiveness applications and instructions that give us a little more guidance on what the definition of these new costs are. So. All right, so the second draw, PPP eligibility. Again, this is a little different because we now know that it's based on 300 employees as opposed to the 500. And when we're looking at that, we're really looking at this as a head count. Anybody that was involved in the first round knows that there was a lot of detailed calculations around FTEs and full-time equivalents. This really just looks at a head count over the last 12 months. So we would calculate on a per monthly basis our head count and then take the average to determine if we're eligible there. There is a requirement that we need to have spent all of our PPP-1 funds first. There's been a little confusion around how the banks have interpreted this. Our interpretation was that you just needed to have expended the funds, which was really, it was your original 8 or 24-week covered period over, and you had spent all of your funds. Some banks have taken this interpretation to say not only did you need to have spent those funds, you needed to have applied for forgiveness and even potentially have received an answer from the SBA on that. So I would say if you're interested in PPP2 and you kind of fall in this period where you've spent the funds but haven't received forgiveness, I would absolutely just reach out to your bank and try to understand how they're interpreting this criteria to make sure that you fit their definition of having spent all your PPP ones, and to see if you're eligible for that second round. And then, as we talked about, you had to have experienced a 25% reduction in gross receipts in any one quarter of 2020 as compared to that same quarter in 2019. So we'll talk a little bit more about what that means, but really what we're looking at is in general, it's hey, let's go look at our gross receipts, our revenue on our P&L. Let's line up quarter 1, 2, 3, and 4 of 2020 and line those up against the same quarter in 2019 and just do a quick comparison to see if there's a 25 plus reduction in 2020. So one of the changes for this CAA as it relates to PPP was the inclusion of 501c6 entities for associations. I don't know if we have any listeners today as a part of those, so I'll just kind of quickly go through these rules here. And Kelsey could probably talk to these a little bit better, and they're a little convoluted, but these do say it's 300 employees or less. There's a maximum 15% of your receipts from lobbying, and there's a requirement that the lesser of 15% or 1 million max expense on lobbying as well. So this is kind of the big one as we look at, hey, are we eligible for PPP2? Is this 25% reduction in gross receipts? And there's been confusion around kind of what is a gross receipt? Is it cash? Is it revenue? And for the not-for-profit entities, it's been a little bit different than some of the for-profit entities. And specifically, some of the confusion has been around, is it a cash basis? Is it an accrual basis? And for the nonprofit organizations, we're really saying you should follow the basis of counting that you use to prepare your 990 return. So when we say what is included with gross receipts, we're really looking at in-kind contribution of assets, gross receipts from the sale of assets or investments without reduction of basis. So what does this mean? In general, right, quick example, if we bought an asset and an investment for $90 and we sold that for $100, we would generally really only think of that as our realized gain is just the $10, right? But for purposes of gross receipts, they're really saying that you need to include that entire amount, that $100. So that's what we mean when we say there isn't that reduction in basis, that $90 isn't pulled out to get to just that $10 gain. We really do have to include that entire $100 amount. So organizations that have sold assets or investments, this has created a little confusion and made it a little harder because that's going to show an increase in gross receipts when, for purposes of the PPP2, we're actually trying to show a decrease. So something to keep in mind there. As we talk about what is not included for gross receipts, that's in-kind contribution of services and use of space. As we talked about, the realized or unrealized gain or loss on investments, we're just saying there that it's not that $10 gain, it's that full $100 that we received on those sales. And then we also know that we do not have to include any PPP any PPP forgiveness that we received in prior years that we essentially had to reclass as revenue or cancellation of debt. That does not have to be included as part of your gross receipts.
Yeah, Andrew, I was just going to jump in. I would say this is the slide that, this is the topic we're getting the most questions on, particularly because as backstory, so the SBA has never dealt with nonprofits before until the CARES Act. That was the first time. Other than that, the SBA only provided lending to for-profits. And so we're seeing some after effects of that as these rules come out. And so, for example, when they came out with the Consolidated Appropriations Act that had this reference to a revenue reduction, whomever said, well, hey, nonprofits have this thing called gross receipts. It's on the 990. There's already IRS regulation around it. Let's just use that. And I think everyone said, great, that sounds good, without maybe looking at, what is that? Because it's not straight up accrual basis accounting, right? As Andrew just walked through, there's some changes you have to make to your accrual basis financials. But the other things it doesn't account for are things like, well, what if your organization is running a capital campaign? So you're bringing in lots of dollars or pledges, and those count as gross receipts, but you're not going to use them for operations. You wouldn't use them. They're probably restricted and you can't use them for operations. Do you have to count them? Well, under gross receipts, you do. So there are some things like that unfortunately, I've had some clients where they ran a capital campaign in 2019 and then didn't in 2020. So for them, it was actually a good thing because it made it easy to show that reduction. But if you were doing any new major fundraising for restricted purposes in 2020, that can be really tricky because you do technically have to show that as gross receipts. So I would say that's the biggest one we're hearing. The other question is, well, what about other CARES Act funding? I work with a lot of organizations here in Minnesota that they provided pass-through funds. So they got CARES Act funds and then they re-granted them out to other organizations. They kept the admin fee on it. That was it. Well, technically that you have to count all of those as revenues. So we are seeing some organizations who are being kind of inadvertently impacted by that. Do we think that maybe at some point they're going to roll out some exceptions to the rules? A year ago, I would have told you that I'm sure they will. They have to make it right. Based on what we've seen, I don't know that exceptions to those rules are going to come out, unfortunately. So we'll talk about some other options that you can look at with the retention credits and things like that. But we are seeing that, there are some nonprofits who are being kind of harmed by this definition of gross receipts. Sorry to jump in there, Andrew.
Yeah, no, thanks, Kelsey. I kind of skipped over that one too. Specifically, it talks about the multi-year grants and pledges, and that's just a good point to make. Is that really, as Kelsey said, a lot of times we kind of true up on an annual basis those multi-year pledges, and that's where we really need to go back and make sure we adjust our accounting for those multiple year pledges in the quarter that they were actually made and include them in gross receipts there. So thanks, Kelsey. When we talk about loan sizing for the PPP, it's very similar to the first round. Really the biggest change for first-time borrowers is that now we know that we can include life and disability insurance as part of payroll costs. Before, we know payroll costs included, the health insurance piece, but the inclusion of the life and disability insurance may allow you to increase the size of that PPP loan by a little bit. So when we look at how do we determine what the size of that loan is, we take all these costs, our gross wages, our health benefits, our retirement contribution expense. It's important to note is the employer portion only of our health insurance and our retirement expense. We need to back out what was withheld from our employees' paychecks for those portions. But when we take those gross wages and our health benefits, our retirement benefits, and now our life and disability insurance expense, and the state unemployment tax. That would be your state unemployment or maybe some local employer tax that does not include federal taxes paid, either federal taxes withheld or federal taxes paid, the employer share of the FICA. Those are not included. But when we take all these expenses for the year, we're going to take 12 months worth of expenses, either 2019 or 2020. We're going to add those expenses up, and we're going to divide by 12 to get an average monthly payroll cost, and then we're going to multiply by 2.5 to get our 2.5 month average of those. So that's going to be the amount that we're going to apply for on our PPP loan. For our first-time borrowers, if that amount is over $10 million, then we're going to be limited to the $10 million. For the second round of PPP, if that amount is over $2 million, we'll be limited to that $2 million amount. For the second draw, they've told us that we can look at these payroll costs at 2019 calendar year, 2020 calendar year, or a trailing 12 months. At this point, we're just now out of January, so I don't think that's going to be eligible or is going to affect a lot of people. But if it made sense to look at February 2020 through January 2021, that's also another option. But those are the periods we look at to determine our average payroll costs, and then do our math to divide by 12 and multiply by 2.5. We've got a note here that NAICS industry code 72 can actually take that amount and multiply by 3.5 months. This is just for a combination in food service entities, so I don't think that will apply to anybody on our call today. So then when we're looking at the application process, what they've told us is that if you were going through that same lender that you did for the first round, so specifically if we're looking at PPP2 borrowers, you might be using that same time period that you used for the first round of PPP. So you might be looking at 2019 payroll costs, and you're going through the same lender. So there's some potential there that the documentation and the application process might be simplified because your bank has all that information, and you could essentially say, hey, I want to apply for the exact same amount. So that's an option, but I think what we're finding is that some lenders are requiring additional information. They might want to see the most recent tax return. We also know that the first round moved pretty quickly, and there was some quite a few borrowers. They look back and say, hey, maybe I didn't calculate that the correct way. So it might be prudent to go back and do a recalculation and pull together that supporting documentation, potentially include those additional life and disability insurance costs to get a little more funding out of your PPP loan. And then again, like we said, at the end of the day, it's going to be up to that borrower to determine what documentation is needed. But certainly you'll have to complete that application, and there's a page worth of certifications that you'll want to be very careful about reading those and before you submit to the bank, and then the 941 payroll forms, and then just proof of all the other expenses that you're reporting as payroll costs may be required as well. So.
Yeah, one note there. I realize our slides are outdated by a few days now. Your Q4 941 should be available now that we're into February, so you should be able to have all of those. Two things. So we're seeing on the lender side that last time around, you all probably remembered, it was just like a race for the money, both from all of your organizations, but also from the banks. And so the banks were just trying to process stuff as fast as they could. Almost every bank just took the minimum SBA requirements, applied those, called it good. What we're seeing this time is that the banks are, some banks are choosing to be a little bit more picky with what they ask for and how they will, if they will or won't approve. So I got a note the other day from a bank or from a nonprofit whose bank said, we want you to fill out this 5-page descriptive, qualitative, response to these 10 questions about, describe for us how your business activities were impacted by COVID. Describe for us how your staffing changed. All of this stuff. And the nonprofit was like, A, we used this bank before, they didn't make us do any of this. And B, like, none of this is required by the SBA, is it? And I said, well, it's not, but technically the bank is still making the loan. They still are on the hook for the loan. They're on the hook, especially if it's a loan that they think the SBA won't forgive, because then it becomes just a loan on their books at a really low interest rate, which means they don't make much money on it. So we are actually seeing lenders start to kind of make up their own rules, which is totally allowable for them to do that around PPP too. So we're seeing those loans go out slower, and we're seeing banks be a little pickier. I just got one this morning before this call where the bank was asking for a third-party certification of that 25% reduction in a quarter. You all know you get an audit on your annual financials. Thank goodness you don't have to get an audit on your quarterly financials, but they were effectively asking for audited quarterly financial statements, which, you know, we as a firm do audits. We don't audit quarterly financials. And so we're trying to go back to the bank and see what they really need from that. But from their perspective, they're saying, hey, if we're going to rely on you telling us you actually had that 25% reduction, we want something that someone else has looked at to say, yeah, they didn't just monkey with the numbers here. So we're not sure what's going to happen with that, but I would just say, I would ask your lender up front before you jump through the hoops of the process. What all are they requiring? What are they requiring in addition to SBA minimums? And if it sounds like they're going to be asking for a lot of things that just are going to be very administratively time consuming for you, it might be worth talking to another lender, because not all lenders are going to do that this time around. So just wanted to add a little flavor of kind of what we're seeing as a lot of our clients go try and get these PPP2 loans.
Yeah, thanks, Kelsey. And I think it's one thing, you know, we all have kind of our own interpretation of the rules, and, you know, we probably think we're right about the interpretation, but at the end of the day on the PPP, we are going through the banks, and certainly they're the ones that are taking the applications and reviewing those and submitting them to the SBA. So ultimately, they're the ones that we really have to adhere to their rules and their requirements. I guess maybe before we jump into kind of our next topic on the employee retention credits, maybe we can kind of pause here and take any PPP questions if anybody has any at this time. Or Kelsey, I don't know if or Nick, if you've seen anything come through the chat.
Not yet. And everyone, feel free to also now, over the next, I'm assuming, minute or so, however long Andrew and Kelsey want to have these questions open for, come off of mute if you'd like. If you're sharing your video, you can raise your hand, you can type in the chat. Now is a great time that you're here live and be able to ask real-time questions as opposed to just rewatching the video. So now's a great time.
All right, I see one coming in here. Pledges are recorded as revenue in the period pledged, not when received, correct? Yeah, that's right. And Andrew kind of mentioned this, you know, I would say our larger nonprofits tend to do a good job of this, you know, recording it. The date that usually your policy says your written pledge is received is the date you record that whole pledge amount, even if it's going to be paid over 5 years. I will say I have some clients where they don't get those things very often. And so maybe they don't do a great job recording that right when they get it, but come year end, they're doing a cleanup, they're going to true their books up and they record it then. Well, what we're saying is to really look at this true gross receipts quarter to quarter, you kind of have to go back through both 2020 and 2019 and make sure that those pledges were all recorded, you know, pull out those pledge forms, make sure they were recorded in the right period. Because that, you know, unfortunately, it's a timing game from are you going to hit the 25% or not? So yeah, the multi-year pledge ones can be a really big swing, especially if you got one really big pledge, you know, in a particular quarter. Thanks, Carter, for that question. Other questions? Okay. Well, if not, we can move on to retention credits, but feel free to put questions in the chat, and we can come back to PPP. We can talk about the other options as well. Okay, so employee retention credits. This is something that they were made possible during the CARES Act, but they were frankly the ugly stepchild compared to the PPP. So the requirements to be able to get them were more significant. The dollar amounts were a lot lower, and in the CARES Act, it said you can get PPP or retention credits. You cannot get both. And so again, you know, other than those organizations who weren't eligible for PPP, like our associations, our C6 associations, those were really the only nonprofits who were looking at retention credits, unless it was those who just decided not to go after PPP. Well, one of the golden nuggets hidden within the 5,600 pages of the Consolidated Appropriations Act was this expansion and change to the ERC program. So employee retention credit, it is a payroll tax credit program. Now, in the for-profit world, payroll tax credits are a somewhat common thing. The federal government uses them when they want to incent businesses to do something. So a really popular one has been the work opportunity tax credit. And it said if you hire this type of employees and you enroll them in this program, you can get a tax credit to help cover their wages. So the government decided in the CARES Act and then now in the Appropriations Act to use this incentive to incent you as a nonprofit or a business to continue employing your people, and basically saying if you were hit economically, but you keep employing your people, we will help cover their wages. Kind of how it works. So even though you are a nonprofit, you don't pay taxes, you are tax exempt, you do actually pay taxes, you pay payroll taxes. And so this program is a payroll tax credit. So that's kind of how it works, is that normally, let's say you work with ADP to process your payroll. Every paycheck period, ADP is pulling money out of your account, pulling out money out of the payroll or the employees' paychecks for payroll taxes. And then every quarter, ADP takes all of that money and then they file the 941, which says here's how much we owe in taxes, and they transmit that money to the federal government, to the IRS. The way these tax credits work is they basically say, well, if we owed $100,000, we now can get a tax credit of $50,000. So we're only going to remit $50,000 and we're going to send you the other $50,000 back. It's kind of the way these work. So the 2020 credits, this program got changed a little bit through the Appropriations Act. But effectively how it works is that you had to have a 50% reduction in gross receipts. So we're back to using that gross receipts definition in a quarter of 2020 compared to the same quarter of 2019. So you can do the same analysis, use it twice. And if you did have that, then you can take up to $10,000 of wages per employee and healthcare benefits times 50%, and you could get up to a $5,000 credit per employee for the year. So there's a little bit more nuance around that, but the big kicker here was if you have fewer than 100 employees, you could do this for any employee who worked for you. It didn't matter if they were working and getting paid or not working and getting paid, you could get the credit. But if you had more than 100 employees, and that's an FTE count, and it uses a different one than PPP, of course. It uses basically an average of 30 hours a week equals an FTE. But if you had more than 100 of those people, then you could only take the credit for employees who are being paid and not working. So frankly, this cuts out a lot of our people, our larger nonprofits. But for smaller nonprofits, if you did have one quarter with a big hit, you can now go back and take that credit. If you had PPP1 and you already got forgiveness, you basically just need to make sure that you had enough of a buffer in your forgivable expenses and your PPP loan amount that if you took off that, say it was $50,000, so you had 10 employees who were eligible. If you took off that $50,000, you still had enough eligible costs. Now we're waiting for guidance for them to say exactly how you should tell them that, especially if you already got PPP forgiveness. But we feel pretty good that if you had enough of that buffer, you can kind of justify taking that credit. How do you file for that credit? At this point, for 2020 credits, you have to file an amended Form 941 for the quarter that you're going to take it. So if it was Q2 where you had the big hit in your revenues, then Q2 you would go back and file 941X for Q2 of 2020, and you would take that credit. Again, if you work with a payroll processor, they can do most of that for you. My one recommendation is ask them what they're going to charge you to file it before they do it, because we have seen some, and I won't name names, who are starting to charge based on a percentage of the credit, and some of the fees are kind of high. It's not that hard to file the amended form. You can do it yourself. An accountant can do it for you on an hourly basis. So just kind of be aware of that. But the big thing was that, as Andrew mentioned, you could now take both. You can take PPP and employee retention for 2020. And then the bigger deal was 2021. So they sweetened the pot a little bit here in a few key ways. Number one, for 2021, you don't have to have that 50% reduction, which, let's be honest, thankfully, very few of my clients hit that, right? They might have had a dip, but not 50%. Now you only have to have a 20%, and it's comparing the quarter of 2021 to the same quarter of 2019. which seems a little bit weird, but they're trying to look at pre-COVID times. So you would take your Q1, and this is all a calendar year, which a lot of you are probably 6/30 year ends. So you're like, that's not my quarter. Well, you have to follow the calendar year. So you would take January, February, March of this year. You would compare it to the same quarter of 2019. And if your revenues or your gross receipts, basically revenues, were down by 20%, then you would be eligible for this quarter. Right now, this runs for Q1 and Q2. It might be expanded if Biden's act passes. They haven't specifically said if this is going to be included, but we wouldn't be surprised. So the other big thing about this one, there's two other really great things. One, that 100 employee cap for not working versus working, that went up to 500. So now you could have up to 500 employees, and you could have them paid and working, and you could still get the credit. So that's huge. That allows for a lot more eligibility. The other piece is, instead of it being 50% of $10,000 or $5,000 credit per year, now with the 2021 credits, it's 70% of $10,000 per quarter. So you can get, if your people make at least $10,000 in a quarter, or basically 40 grand a year, you can get $7,000 per employee per quarter. So $14,000 for the first 6 months of the year. That can be really sizable. So for a lot of our organizations, they're looking right now and saying, I know that I had to move my gala, which normally happens in March. I had to move that until August. So now I know that my revenues are going to be way lower in Q1 because I don't have that gala revenue that I had in 2019. Therefore, I know I'm going to hit that reduction in revenues. And I think I'll be eligible for this credit. The other nice thing about these credits are purely a tax mechanism. You do not have to justify need. You don't have to certify that economic uncertainty makes it so that you need this credit. It is just a tax program. So that is one really, really nice thing. I know a lot of organizations are debating if they need the PPP loan round 2 and if they can certify that they need it and feel good about that. The tax credits, you don't really have to jump through those hoops. I do see a question in here. 500 employees, is that still on the FTE 30 hours, not employee counts? Good question, Carter. So it is basically the way, I'll describe it this way. So the retention credits are run by the IRS. PPP is run by the SBA. Two different parts of the federal government. Totally different rules, of course, because we have to make it fun. So the way that the IRS is defining employees is the same way as in the ACA. So you can kind of look up how does the ACA define employees. I believe it's still on a 12-month, so you would still look at the last 12 months. But then I believe they use 30 hours equals a full-time equivalent, and it's 500 full-time equivalents. I will double check on that for you. But yeah, it's a different definition of employee counts than on the PPP side. So that is 2021 credits. Great question here too. The other thing I forgot to mention is it's that 50% or 20% reduction in revenues or a full or partial government shutdown. Now, that's where the fun comes in, because what do they mean by a partial government shutdown? Great question. So there are starting to be more FAQs about this, a little bit more guidance. But generally what they've told us thus far is that partial government shutdown has to be what do they say? A sizable, I don't think they use the word sizable, but a reasonable portion of your business is no longer able to operate in the normal way it would operate. And you are not able to replace it in the same way in a virtual setting. So, with some of my higher ed clients, we're having this debate right now of like, okay, well, let's say they're in California and their campuses are shut down, but they moved to fully online. They're doing all of their teaching online, but they had to close room and board. They had to close athletics. They had to close, the bookstore and cafeteria and all of these other things. But their tuition revenues have stayed the same and they are still doing the education portion. So then it's this debate of, well, how much of your business is the housing and athletics and all of those other things? And does that constitute enough that you could be considered partial shutdown? Again, so it is a facts and circumstances evaluation. And I will say our whole tax credit team who specializes in this are all attorneys. So they get really into that analysis. But it is really having to look at, what is your business? What are the ways in which it's been impacted? What are the things that were impacted? How much of your business does that constitute? To be able to determine, do you feel comfortable claiming that you were impacted significantly enough by this partial shutdown that you could claim the credits? So it doesn't necessarily, it's not a one-for-one of saying you have to look at your revenues and the reduction in revenues. But if you had no reduction in revenues, but you're claiming partial shutdown, that's a tough case to argue, I would say. So the other example I'll give is I work with some associations. And so one of my clients, they're headquartered in Minnesota. They were supposed to have a conference in New York last May. And obviously New York was completely shut down. So they were not able to have the conference, and they moved it to a virtual conference. But that virtual conference was about a third of the size. Most of their sponsors pulled out. It ended up being a much smaller event. And so, but their revenues only ended up going down by 45%, not 50%. So the question was, do they qualify as partial shutdown? When our retention credit team kind of consulted with us on this, and they said, if we look at that event over the course of your year, that event is about 35% of your annual revenues. That event itself shrunk sizably. The reason they only hit 45% was a timing thing. And it was a significant impact on their business. And so they did end up saying, we would feel comfortable saying you qualify under that partial shutdown. So unfortunately, this is one of those where it's good to consult with some experts on it and, kind of document all of that. We don't yet know how they're going to be auditing the retention credits. We are sure they will, but they haven't released an audit plan. So it's one of those, it's pretty easy if you meet the 50% or the 20% gross receipts reduction. It's not so easy if you're claiming the shutdown. So make sure to back it up. Thanks, Katie. That was a great question. And I had skipped right through. That is an option. The last thing I'll mention about the 2021 credits is how the heck do you get your hands on that money? And so you can do two things. One would be you can actually claim that credit in advance. So if you're looking at Q1, you're looking at January, February, March, which we're almost halfway through that now. And you're saying, we know we're going to be down by 20% for sure. You can actually claim the credit in advance. Now, I believe we're still waiting on the form. We think it'll be called Form 7200, which is what they use for 2020 credits, that you file. You can work, again, through your payroll processor to file it. And you basically say, here are the wages that we believe will be eligible. Here's the amount we calculate we should get. And so you claim that credit in advance, and you will actually get a check in the mail from the IRS. It's a beautiful thing. So you can claim it in advance, and then if you end up getting to the end of the quarter and it ends up being the wrong amount, then you can kind of true up on your 941. Or you can just wait till the end of the quarter and you can file it as part of your quarterly 941 filing. Again, probably your payroll processor does that for you. So you just work with them to file that, and then they will kind of hold back that amount of money from what they send the government, and they will transfer it to you. All right, really quick on Shuttered Venue. Looking at the list of people who are going to participate today, I didn't see any that stood out by name, but Shuttered Venue Operator, it was kind of formerly known as Save Our Stages, or SOS, which I thought was a great name, but they changed it. So the SVO grant, and this was basically, it was actually really cool to see a group of all of these mostly performing arts organizations and places like that, theaters, banded together and went and said, look, like, we are getting just killed by this, pandemic and the shutdowns. Like, we can't operate. And we, all of this whole industry is being really impacted. And so they created this program separate from PPP, separate from employee retention credit for these organizations. The amount of the loan you can get can be significantly more. It's up to 10 million, whereas the new PPP2 is only 2 million. So, and it has to do with your receipts from those ticketing opportunities and the reduction that you saw. Now, this program has been slow to roll out. They still have not yet said when it's opening. And they are, I would say, slow at kind of giving definitions around it. There was guidance that came out last week that said, don't even apply for a PPP loan if you think you want shuttered venue. So that was a change. We had a lot of organizations withdrawing PPP applications in that instance. But this is structured as a grant. It's not a forgivable loan, so it is kind of revenue right when you get it. There will be some reporting on the back end. But for our organizations who have really been kind of closed down for performing arts, this is a really big opportunity. So I'm not going to go into too much more detail here. We will share these slides if people have specific questions. I'm happy to answer it to the extent we can. Again, this is probably the program we have the least guidance on at this point. All right, so with that, I'm going to pause really quickly and just see if there are additional questions about the retention credits. Otherwise, we will go into the case study, which hopefully brings it all home here and kind of shows how all of this works together. But any additional questions on retention credits? All right, great. So here is our case study. Like I said, real nonprofit that this happened with. So organization with a $2 million budget, they got a $250,000 PPP loan back in the spring. They spent it all, but they have yet to apply for forgiveness. They just hadn't gone through that process yet. They did see some reductions in Q2 and Q3 of last year, funded due to closures of their programs. They did end up reducing some of their headcount, and they may have to make more reductions if they don't get PPP2. And then we didn't talk before about FFCRA credits, but those are those Families First Coronavirus Act. And those were if you have people out who are sick with COVID, or they're caring for someone who's out with COVID, if you provide them leave and you don't make them take their sick time, you provide them paid leave, don't take sick or PTO, then you are eligible. There's a few other small rules, but that's the gist of it, for these credits. And you can get up to a couple $1,000s per employee of credits. So the reason I have that in the case study is we need to be mindful of that as we think about PPP forgiveness, because that's another no double dipping situation. All right, so here, this is a 6-step, what we've done with almost every one of our clients at this point to kind of figure out what are you eligible for? How's this gonna work? So hopefully, again, this is something you can take and try at home. So the very first thing we would do is say, come up with that 2019 quarterly financials, 2020 quarterly financials. What I usually do is, go into my client's accounting system. Let's just run your revenue straight out of your system. And then let's do a little spot check to make sure that we booked things in the right time period. And then let's do an adjustment on the gross receipts, which for very few of my clients does that end up being anything. The real big thing is if they have investments and they sold those investments to pull out cash at any time, then we need to make adjustments for those gross proceeds, which can be a big swing. So make those adjustments and then look at what was the change from year to year. So you can see in this situation, this client, Q2, they were hit hardest. Their revenues normally are their highest of the year, and they dropped in half. So they had a 50% reduction in Q2. You can also see in Q3 and Q4, they were down, but not by quite as much. So that's kind of step one, is to do that analysis. So step two, did you have a 50% reduction, or again, that partial or full shutdown? They did have the 50% reduction. So we say, okay, in 2020, you now can add $100,000 because they had 20 employees during that quarter, and then they can get $5,000 per employee. So that's $100,000 we can add to kind of our running list. You'll see I already have that $250,000 PPP loan here in that 2020 column. So in total, we know that they were eligible for $350,000 of 2020 support. All right, now we need to see, okay, well, that's great if they take that $100,000 in cost or in credits, but can they still get to full forgiveness on this $250,000? Again, they're past the end of their covered period on the PPP, but we want to make sure when they apply for forgiveness that they can still get this full amount, even if they take retention credit. So basically what we would do is say, okay, let's look at all the eligible costs in their covered period. Let's back out for that $100,000 of PPP or of ERC. Let's back out for the FFCRA credits. as nonprofits, we get to deal with the fun of restricted funding. So we need to look and say, did we have any funding that was restricted for use in payroll? Like maybe a cost reimbursement grant that we charged payroll to? Well, we got to back that out too. That's not eligible. That's that double dipping issue. And then for this organization, they did make a reduction in staffing. And so they have on the PPP side, this reduction quotient that they have to apply. So that's a much bigger analysis. I didn't include all the details here. It will tell you at the end of the day, we were able to get them to 100% on PPP 1 forgiveness. So we keep that number at 250. But if the analysis said, yeah, we really can only get to 200,000, we would change this number to 200, and we would know that there's a loan of $50,000 out there that they would have remaining. Or we could say we're going to take less in retention credits, and we want to get the whole PPP forgiven. You could do it either way. All right, now step 4. So now we know, because if we go back here, we know that they did have 2 quarters in which they would qualify for PPP2 because they had gross receipts reductions of 25% or greater. So we know we're in for PPP2 if we want it. So now we have to figure out what would our PPP2 loan amount be. So this is, Andrew did a great job describing why you might want to recalculate. I've had a lot of clients who said, oh, I can just take the same amount I got in for the last loan, I'm just going to do that. But what I've typically suggested is let's actually go in, let's run this analysis. A lot of my clients last time around, it was a rush. They just wanted the money. They just used payroll. They didn't include benefits. They didn't include some other eligible costs for sizing. So their loan technically was undersized. So with this client, we said, okay, let's kind of redo this calculation. And this time around, if we use their 2020 payroll, they actually got to 282,083. So higher loan amount, let's use that one. So you can see now we're going to plug that in PPP2 for a 2021 opportunity. Next step, I swear we tried to make this simple, but this feels like a lot of steps. Next step is to look at where do we think 2021 is going to land. So we're going to do some projections here. Again, remember, we're comparing back to 2019 to pre-COVID times. So we're going to look at where do we think 2021 Q1 is going to land? Where did 2019 Q1 land? Same thing for Q2. We can see that in Q1, we think we're going to be down, but only by 14%. There's no shutdown in order that's really impacting our business. So we don't actually think we're going to be able to take retention credits for Q1. But we look at Q2. We expect a 36%. Okay, we think we'll be able to get credits there. $7,000 times 20 staff, that's $140,000. So that's what you see here in 2021. Now we know for PPP2 that we get 24 weeks to get to that 282 of eligible costs. So we feel pretty good that we can take the $140,000 of credit and still get to full forgiveness there. All right, so all that said, you can look at this chart and say, wow, this organization can benefit pretty significantly from these opportunities. They can get $350,000 for 2020. They can get $422 for 2021. That's incredible. That's really helpful. Think of what it would take to fundraise that. And then there's this question we need to consider, which is economic uncertainty. So if you remember back in the craziness of March and April when PPP1 came out, there was a certification box that you had to check, or actually you have to initial on the PPP loan application saying economic uncertainty makes this loan necessary to continue my business operations. Now at that point, everything was uncertain. We had no idea what was happening. It was pretty easy for everyone to just sign off on that, submit the application. Well, then some people started digging into it and there started being questions about, well, was there really uncertainty? Do we feel good about this loan? A lot of folks did return the loan by May 14th, which was the safe harbor date. And then right around that time, the SBA came out and said, okay, we're going to say that any loan under $2 million, we are going to assume you needed it. So we are not going to audit you for economic uncertainty unless your loan is over $2 million. So for a lot of our nonprofits where their loan was $500,000 or $100,000, kind of big sigh of relief of like, okay, we felt good about taking it, but we were nervous about getting audited. Now we don't have to worry. Well, this time around, that clause remains. So if you're going in for PPP2, you have to sign the same thing. It says economic uncertainty makes this loan necessary to continue our business operations. And there's some questions out there. The SBA hasn't said, does that safe harbor still apply this time around? Might they take PPP1 plus PPP2 and say that amount needs to be under 2 million for Safe Harbor? We don't know. So we are suggesting that, especially as nonprofits, that we go to the board with this, that we have a conversation and say, okay, are we eligible for PPP2? Sure. Do we need it? What does our forecast look like for this year? What might we do differently if we get those dollars? So I'll give you a couple, for instances, of conversations I've had with clients recently. One was a client where they did qualify in Q1 of 2020 compared to Q1 of 2019. You remember, Q1 was kind of pre-COVID. They happened to just have gotten a really big pledge in 2019 in Q1. They didn't get the same pledge in, the same quarter of 2020. So technically, they were down by 40-some% that quarter. However, on the year, they ended up actually having a really good year in 2020. They ended up being up like 30% on their revenues, and actually, coming out pretty well on the net as well. And so we took this analysis to their board last week and said, look, technically, you'd qualify for another $210,000. You could probably go after it. Are you going to get audited? Probably not. But do we feel good about that, knowing the results of your year? No, we don't. We would not recommend going after that. The tax credits you're eligible for seems appropriate to get what you're eligible for on the tax credit side. But we are not feeling good about anyone signing that certification for PPP2. On the other hand, I was talking to a C3 association last week whose revenues for the year last year went down by 85%. They're like, yeah, we're forecasting break even this year, but it's because we cut 40% of our staff. We have pared down to the bare bones. We cut retirement contributions. We cut all of this stuff so we could break even. And if we aren't able to have some events this year, we're going to be facing cancellation fees. But we don't know if we feel good about signing economic uncertainty. We're like, yeah, I think you can feel okay about signing that, right? Like if you get the PPP loan, you've already said you plan to hire some additional staff back. You plan to restore the 401k contribution match. You plan to do these things for your employees. That's the whole point of this loan program. And B, you have very good reason to say you are uncertain about what this year looks like. So it really is that analysis, that facts and circumstances test. But I've laid out here for you some questions that I think are good starter questions to have that discussion with your board. If you are in that spot of we're eligible, but we're not sure if we should go after it, highly recommend have the conversation with the board, document it in board minutes. Anything that you bring to support that, like if you do a forecast or an analysis, like save that in your PPP2 file where lots of people in your organization know where it is. Regardless of if you go after it or not. It's really helpful to have that backup. And again, just to remember, what did you know today when you made the decision about the loan, which is going to be different than what you know a year from now if you get audited and have to justify why you went after it. So want to just be sure that everybody, kind of acknowledges that while you're maybe eligible for all of this, or this organization was, that it's really important to have that discussion to determine if you want to go after it. All right. I see a couple questions in the chat here.
Yeah, Kelsey, Peter asked, can a nonprofit that presents an annual festival in a park qualify for a Shuttered Venue Grant? Do we have enough clarity on that program?
Good question. So Peter, I will first say that I am not an expert on Shuttered Venue. We have a couple of team members who are kind of digging into it further, so I can clarify with them. But the Shuttered Venue Grant, Shuttered Venue Operator Grant, there is some pretty specific guidelines around eligibility. And so if you take a look at, you have to meet that a certain percentage of your revenues do come from that activity. There are some rules around having to pay performers. So I know we were looking at an ice arena the other day where it's like, they host some concerts, but that's a very small portion of what they do. They mostly run college hockey tournaments. Those college hockey players are not paid. So that right there kind of threw them out of eligibility. So I think for your festival, you would have to kind of look at each of those things and look at it in the totality of your organization to see if you might qualify for that shuttered venue. So happy to follow up offline and share a little bit more detail on that because it's a little bit nuanced on who exactly qualifies.
Thanks, Kelsey. Carter just wanted to clarify, and Carter, correct me if I'm wrong, that when we're looking at our 2021 ERC credit, we are actually still comparing those back to 2019, not 2020.
And that's both first and second quarters. Once we get to third quarter, if this continues on, we'll be looking at 2020 or not? Or are we still going to be looking at 2019 for the whole time?
Yeah, good question, Carter. So right now the program is only authorized through 6/30 of 2021. So it's only Q1, Q2, and those are comparisons to 2019. My guess would be if the program gets extended, they're going to continue referencing back to 2019, because what they're trying to evaluate was how was your revenue impacted today versus pre-COVID. So if they started comparing to 2020, they would be comparing to a period that was impacted by COVID, and they're really trying to look back prior. But as of right now, we don't know about anything, for certain beyond Q2. So stay tuned on that, but my gut would be that it would still compare to 2019. All right. Looks like, Andrew was answering that one. Folks had to step off.
Katie's got a question. Says, we have a weird situation. We have existed since 1997, but through January 31st, 2019, we operated as part of our local county health department. However, on January 1st, 2020, we spun out as our own 501c3. Are we going to have trouble with any of these since we technically didn't exist in 2019, or we existed as part of another entity?
Yeah, so great question. And there's some guidance around both new entities and spinoffs and mergers and acquisitions and things like that. The rule is that to be eligible for PPP, either round 1 or 2, that you had to be in existence by February 15th of 2020. So if you spun off as your own on January 1st of 2020, you're good there. You meet that qualification. Now, what will be a question is, how do you size your loan? If you're using historical data, at this point, you can probably size it on 2020. You were in existence for all of 2020. So that's probably actually a way to simplify it, is that you can size your loan based on that. Now, for PPP, that is. Now, for employee retention credits, where you're trying to do that look back, that does get a little trickier because you didn't exist as an organization. So I may have to do a little looking into how that would work for retention credits. If there's a way that you can kind of say, well, we operated as an independent program prior to that, and we had independent financials that just got rolled up, that might be an option for it, but I'm not certain. So I'll have to double check on that for the retention credit side. But for PPP, you should be good because you were in existence as a standalone by 2/15/20.
Thanks. Yeah, we can pull our financials separately. We didn't technically exist. So.
Got it. Yeah, I'll double check and follow up with you, Katie, on that, on the retention credit side, to see if there's any guidance on what to do there. Great. Any other questions folks have? All right. If not, we will send these slides out after. Here are some links to some other things to think about. This nonprofit PPP considerations is a blog article my colleague wrote that kind of really goes through all of that gross receipts definition stuff in a little more detail that should be helpful. This employee retention credit 2020 and 2021 comparison is an article our tax credit team put together, and I think I pull it up probably 10 times a day. It is really, really helpful. So I would highly recommend checking that out. And then our firm started doing, back in March, I don't know whose brilliant idea in marketing this was, but this information was changing so quickly. We said, how do we get information out to people when it's changing literally every day? So we started just doing live streams. They're 30 minutes Thursday afternoons. We are planning that content Thursday morning so that it is the most recent stuff that we know. And so those are every Thursday. They're free for anyone to attend. It's just our way to kind of get you the most latest and greatest. And there is a Q&A function. So we do a lot of answering questions on those. And then we've got a lot of articles and stuff coming out too. I did also just want to mention if any of you are interested and you want to have like a quick 15 or 20 minute consultation to talk about your situation and what you might be eligible for, we are happy to do that, for free for any members of the Colorado Nonprofit Association. So feel free to reach out to myself or Andrew. Our contact info is here, and we can line up some time to chat through your situation and what you might be able to seek in resources to help you out. I think that's all we've got. Andrew, any last parting words here?
Carter looked like he was asking, how do we attend those sessions?
I'm
for the
guessing you are
CLA
asking
live
about,
stream?
those live streams. So there's a link here. You just go in, you put in your contact information, you will get a calendar invite to it. And I think you can sign up to just get the calendar invites for every Thursday. And then you just have a link that you follow to participate.
And if for some reason you're not near your computer, I know that those can be streamed through YouTube, so you could probably just search CLA as well. So.
Exactly. All right, so we will send out the presentation. I saw that question. I think Nick's going to get these slides out as soon as we get them to him, and probably a recording as well. And like I mentioned, feel free to follow up with us. We are happy to help any way we can, because there's a lot of government support out there, and we are just super passionate about making sure it gets in the hands of the organizations who need it most. So we'd love to help you through that. All right.
Excellent.
With that, I think it's a wrap. Nick, we'll hand it back to you.
Thank you so much, Kelsey and Andrew. Thank you. This is great. This is awesome. And as Kelsey and Andrew both mentioned, we'll follow up too with all this information. So keep an eye on that for today, unless Zoom has some issues downloading the recording, then by tomorrow morning. So you can just feel free to respond back to that too if you have any questions, and also put the contact information for Andrew and Kelsey too. Yeah, so we look forward to having you back in another one of these trainings, but everyone have a great rest of your day. And Kelsey and Andrew, thank you so much for joining and presenting today.
Thank you. Bye-bye.
Our pleasure. Have
Take
a
care,
great
everyone.
rest of your week. Bye.